Welcome. Today we're tackling a vital question. How can we shape financial markets so they truly serve Africa's economies? We'll look at what's working, what's holding back progress, and how we can turn visions into action. This is Financing Africa's Future. Here's a quick question for you. If you had to pick one barrier that holds back financial markets in Africa, what would it be? Drop your answer in the comments as we go through. By the end, let's revisit your answers and compare. Let's start with why financial markets matter. First, they help mobilize long-term capital for things like infrastructure, energy, and housing. Second, they provide local currency financing, which helps reduce foreign exchange risk. For many African economies, issuing debt in foreign currency has created serious vulnerabilities. Third, strong markets enhance resilience, enabling economies to better absorb shocks and diversify away from relying solely on bank lending. And fourth, when they are inclusive and transparent, they support sustainable growth through instruments like green bonds, digital finance platforms, and better access for small and medium-sized enterprises. Think for a moment. In your country, what's the most obvious gap in the financial market? Is it a lack of savings, a lack of investors, or a lack of infrastructure? Make a quick note. Now, let's zoom into the challenges. These are real and persistent across many African markets. First up are regulatory and legal frameworks. Many countries face weak or fragmented regulation, unclear enforcement, and slow legal systems, all of which raise risks for investors. Next is market infrastructure and depth. We're talking about shallow markets with limited instruments, low liquidity, and high transaction costs. For example, the market capitalization of many African exchanges is well below that of their peers in other developing regions. Another challenge is the limited domestic investor base. Pension funds, insurance companies, and retail investors often lack the scale or participation needed. Without a strong domestic investor base, markets really struggle to grow. Then there's credit and currency risk. Currency volatility, weak credit ratings, and a reliance on foreign currency debt all raise the cost of capital, making it more expensive to fund projects. Finally, we have macroeconomic and sovereign risk. High inflation, fiscal pressures, and heavy external debt loads all undermine investor confidence and make long-term financing much harder to secure. Which of these 5 barriers do you think is most urgent in your region? Type the number in the comments. The good news is, there are strong opportunities and innovations gaining traction. Let's highlight a few. First, there's blended finance and the work of development institutions. This involves using public or concessional capital to de-risk big projects, making them more attractive and investable for private money. We are also seeing a rise in green and thematic bonds, which are used to finance climate adaptation, renewable energy, and other infrastructure aligned with ESG goals. Digital finance and fintech platforms are another game changer. They help broaden access to capital markets for retail investors, underserved populations, and small businesses. We are also seeing progress in regional integration and local currency issuance. This means linking exchanges, harmonizing rules, and issuing debt in local currencies to reduce foreign exchange risk. And finally, there's a push to strengthen domestic capacity by developing local rating agencies, building up institutional investors, and implementing stronger governance frameworks. Imagine you're a small business owner in your country. Which of these innovations would most help you access capital? Blended finance, digital retail platforms, or local currency debt? Share your pick and your reasons. To make this potential a reality, here are the key policy and institutional levers that matter. First is regulatory reform, strengthening frameworks for disclosure, corporate governance, especially for state-owned enterprises, and investor protection. Second is investment in market infrastructure. This includes clearing and settlement systems, credit rating agencies, standardized disclosure, and modern trading platforms. Third, it's crucial to promote local currency issuance and develop yield curves. This helps reduce foreign exchange risk and builds local investor markets. Another key lever is to support blended finance and catalytic capital, using public money to pull in private finance for big, essential projects. We also need to encourage fintech and digital access, making capital markets accessible via mobile and digital channels, especially for retail investors and SMEs. There's also regional integration, linking markets across borders, harmonizing regulations, and pooling savings and investors. And finally, we must build domestic investor capacity and financial literacy to grow our pension funds, insurance companies, and regulatory expertise. If you were advising your country's finance minister right now, Which one of these levers would you suggest as the top priority, and why? Write it down. Let's take a quick snapshot of the facts. According to recent data, private capital investment in Africa dropped in 2023 compared to 2022. For example, venture capital and private equity saw declines, while infrastructure investment actually surged. Many African countries are grappling with external debt burdens and have limited domestic markets, which deepens the need for local financial market development. On the positive side, digital finance and mobile money platforms are creating powerful new opportunities for inclusion and access across the continent. Does this align with what you see on the ground in your country or region? Which figure surprised you the most, and why? Here's how you can engage. If you're an investor, whether institutional or individual, ask, are there local instruments I can access? Can I support local currency bonds, ESG projects, or SMEs? If you work in policy, regulation, or academia, think about how you can support market infrastructure, financial literacy, and better governance in your country. If you're an entrepreneur or run a small business, explore digital finance platforms, co-investing structures, impact bonds, and engage with your local capital markets. And most importantly, join the conversation. Share your country's success stories, its barriers, and its innovations. What's working where you are? In the comments below, share one idea from today's video that you will start acting on or researching further. Let's build a community of change together. To wrap up, shaping financial markets that meet Africa's needs isn't just about finance. It is about unlocking growth, resilience, inclusion, and sovereignty. If we get the regulatory frameworks right, invest in infrastructure, deepen local markets, and broaden access, we can unlock Africa's future. I want to turn back to our opening question. What barrier did you pick? Revisit your answer now. Did any of the opportunities or levers we discussed shift your view? Thank you for watching. If you found this valuable, please like, subscribe, and share. Let's keep the conversation going on financing Africa's future. Until next time.